Welcome back to your work week with OETV. We hope that you enjoyed your weekend, and it was an eventful one with a new king for the United Kingdom, upsets galore in college football, the NFL season kicking off, and of course, the 21st anniversary of 9/11. Markets look set to continue their rally this morning, helped by reports that Ukraine is making inroads into Russian-occupied territory. There is a lot to discuss this morning, so let's get to it with Brendan McCarty from Column E. How was your weekend, Brendan?
Busy as always.
All right, last week markets finished strongly. So we're looking at a bear squeeze, or we're looking at a legitimate rally. There was quite a bit of media last week highlighting that institutional traders bought $8.1 billion worth of put options. Compared to the volume seen in the 2008 crash, that volume is 3 times larger. Recession fears are high amongst all investors right now, and that could be a reason for some of this activity. Brendan, I saw some of your thoughts on Twitter about this, but talk to us why this has you concerned.
So this is interesting. I initially was like, wow, I mean, this is from Jason Gephardt, originally from the Sentiment Trader. He posted this chart, and it was a pretty dramatic chart with all the puts. And then somebody responded. Basically, it was interesting. They said that it was one dealer putting on a ton of puts, so they were hedging out a book. It seems like an insane amount of puts, really. But if you look at it this way, the S&P was 1,200 in 2008, around that point. Right now, it's at 4,100. 3 times the S&P is actually 4 times what it was back then, almost. So the 3 times number is pretty big, but it's just relative more to the environment, I think. I mean, they were paying $8 a put or something, if I'm not mistaken. So they were way out of the money puts, like somewhere in the 2,600 range. Because we just bought some for December, and they weren't $8. I'll tell you that. With the market itself. There's a lot of correlation to 2008. There's a chart that I saw on Friday that showed we're about to drop again. I don't know. I mean, it just seems to be a lot of negative sentiment. I think the story right now is what we posted last Thursday. It's all about money. If the Fed's going to open up the spigot and let you buy, give you money to buy, assets are going to rise. If they're going to take the money out of the system, assets are going to fall. And our report on Thursday showed that money rose pretty sizably for the first time in 4 weeks. That rise was followed by a rally in stocks. If you go back to 3 previous reports, we sold off each time, like clockwork, after the money was sucked out of the system. So this rally is all about money, up and down. I wouldn't chalk it up to more than that. I know there's other factors out there, but so goes the money, so goes this market. And right now, I mean, part of us, I think we speculate if the Fed keeps pumping to try to offset these rate hikes because they somehow think money is a way to do it, you could have a melt up in stocks only because there's so much cash chasing it around. And look at crude oil. Crude oil finished. Crude oil got pummeled on Thursday. I think it went all the way down to $82 at 70, almost down to 80. Fed pumps in some money. Crude's backed up to 86. I think it's 87 today. If gold would confirm my little theory, all commodities would be rallying. But I would just chalk this up. Follow the money. That's the way you want to say it. The S&P 4150 is a big level we're sort of watching. There's a lot of moving averages there. There's a lot of trends there. If the Fed continues to pump, this market's going to continue to climb because earnings aren't falling off a cliff. Earnings are actually stable to higher. So you got money coming in from that. You got money coming in from the Fed versus rate hikes, which they don't do much these days. It doesn't seem like they're doing much. So that's the way I'm looking at it anyway.
Okay, well, taking all of that in, could there be a further squeeze coming if we see the CPI number come in below expectations? Jay Pulaski, a regular guest on OETV, has been saying that inflation could cool down a lot quicker than the market is predicting. Estimates for August are for 8.1%. Brennan, if we see this number below estimates, could this be a catalyst for an extended rally?
So I think the CPI rally is over. I think it's more of, if it's a bad number, you've got to sell. Weaker inflation is priced in. Jay's saying this. That's what the market's saying. I would just look at this. I think the upside on this inflation reports is limited. I think in fact, gasoline, I think Bloomberg reported has fallen 88 straight days, if I'm not mistaken. Where I paid $3.30 a gallon yesterday, which is just fantastic when you're driving your kids all over the world. But basically we're not in that season where energy prices are driven, no pun intended, by gasoline, but more by heating oil and energy, heating oil and natural gas. Heating oil has been stubborn as all anything. It will not fall. I know jet fuel is distillates, is a part of a distillate product, and people use heating oil to hedge out distillates. But long story short, yes, the CPI will probably come in lower. I mean, gasoline's just been tumbling. But I think that the market won't care. I think the market's pricing in that. They're pricing in misses. If this thing were to rally and jump, I don't know what would drive that. Rents are pretty hot, and they are rent equivalent. But prices, housing, I think, is moderating, which would drive the rent number down. So I think tomorrow's number won't matter as much. I think what matters is the future numbers. And like I said, the Fed can hammer demand all they want with rate hikes. If they don't suck the money out of the system, when the demand returns, it just drives the inflation back up. So I think this number doesn't matter. I think you watch future numbers more than anything. If this number were to jump, that would be not predicted. And I think the market would sell on that. But I think if the number misses, you get a little rally. I wouldn't put too much into it beyond that, though.
Okay. All right. Now, believe it or not, Brendan, there's still companies that have some earnings this week. So let's go have a look at some of them. And obviously there's some big ones as well, because otherwise I wouldn't bring it up. Oracle reports after the close today. The share price is a lot like a lot of tech names we've been looking at in the past, and it has been making some inroads into rallying back since its sell-off in December last year. Their cloud business, whilst growing, is in a very competitive space here. What do you think we could see here, Brendan?
Few interesting stats first, heading to set this up. Stock's been outperforming this S&P this summer. I think that was driven by the beat last time. Nobody expected Oracle to beat last time because I think they were swimming. Everybody was thinking there's another Microsoft, Microsoft was moderate, and Apple. Yeah, a lot of the companies in their space missed. Let's just put it that way. Oracle beat. Call options heading in this number are up double what they normally are relative to the past 20 days, but puts are up big too. I think investors are hedging downside, thinking Oracle is going to miss again. The analyst community is also a little bit mixed. I can't find many positive analysts these days because they're all herds anyway. They all travel the same. They're all walking down the same path. So if the world is weak, we're all weak, right? But they're all saying that they think application software will do fine, but the infrastructure products will be weak. Well, Oracle went out and bought Cerner. So, and Cerner's on the infrastructure side. So if it will, Cerner might be a drag. I think Bloomberg was saying that Cerner will be a drag in the short term, but the short term doesn't matter when you have something like Cerner adds your books. You're looking at the long term. What does it add to margins? And I think this will be they'll say maybe weakness in infrastructure in the short term, but we got Cerner now and our earnings are going to rise. So needless to say, I think that's going to offset that argument that many are feeling. The cloud business, they're behind. They're catching up. They have a lot of players. I guess they have a lot of database players that are not in the cloud yet, which I find fascinating. I didn't realize anybody. I know a lot of people have databases. My old firm had it locally, and then they went to the cloud years ago. But Oracle still has a lot of database clients that are not in the cloud. So like hard computer stuff. They have a lot of. They can make a lot of money by transitioning them to the cloud. So they have a lot of built-in future revenue from that. My feeling with the companies, I think it's expected to miss because the sentiment's so poor, but they beat last time against the odds. And I think I think it's on the table again. I think they could beat again. I mean, Ellison is still there. So whatever happens, I mean, he's still the guy pulling the strings from wherever he is these days. I don't think he's, so I can't, the market's betting against the company again. And I think they might be, I don't know, just call it a hunch.
Okay. Now, Core and Main reports tomorrow morning, and they've been listed a little bit over 12 months, so a relatively new company on the stock exchange. And share price hasn't really done much since listing. Seems analysts don't really know what to do with it at these levels as well, with a consensus hold recommendation. Insiders have been selling the stock though, so maybe it is a good time to be sitting on the sidelines in this one. Brendan, have you ever looked at this name?
I never heard of it until you mentioned it. They've only been around since 7. It's funny when I looked at the chart; they look like a utility. Put the XLU up against them. I didn't even think to do that, but I would say that they've only been around since 2017 too, which is remarkable. that they went from 0 employees to 4,100 employees in 5 years just by buying one company after another. They're in a mixture of sectors from what I can gather. Real estate is one of their, I mean, they're in that, they're doing fire protection for these buildings. They're doing a lot of different things. That part's slowing down. There's probably no doubt about that. I think building costs are going up. Lumber has come off, but you go back to the same story we said before. The Fed doesn't tie off the spigot, lumber prices are going back up, and metal and cement and all that sort of stuff. There are also municipalities, which is kind of a cool sector. I have relatives that are actually in that sector that they go into the pipes, and a lot of these municipalities, like hundreds of years old pipes, like here in Amesbury, our pipes are well over 100 years old in some cases. And there's always one water main blowing up. Well, their technology, they get these synthetics that go into these pipes to make these pipes stronger without pulling the pipes out of the ground. I mean, how much money does that save? How much effort does that save? Less manpower, very efficient. And they're going into municipalities all over the place. They're looking at wastewater. It's an interesting company. I mean, the chart doesn't show that they're growing. It looks like it's sort of stuck in a range. I mean, 25 to 21 is its current range, but it's been positive over the last several weeks. It's just been sort of sitting there climbing higher. I wonder if the investors are betting on a positive outlook, a beat maybe of sorts. Tough stock to gather because there's not really much information on it. But I mean, it's not a boring utility. It's a kind of a cool utility, if anything. I mean, they're in a lot of stuff, but the analysts have been jumping in and out of it. So it's like you can't tell what they think either because nobody will cover it. So kind of a fascinating company. So I wonder if the market's betting on a beat. We'll see.
Well, I'll have to make sure we coin that phrase for you. Cool utility. That's something you don't hear in the markets. Adobe reports on Thursday after the close, and this chart is not a pretty one for Adobe holders. Decent earnings last time, but FX has been a big issue for them. Brennan, is this a steer clear situation?
The outlook on the analyst side is not good. It's pretty bearish, but they're all using the same arguments, which so generic. Get original. Weak global economy, strong dollar, tough comparisons. I mean, seriously, you can tie that to anybody these days. I do get the feeling that business slows a little bit with Adobe. We use it here, but it's not. It's like they don't do a transaction business. They're more of a fee based. But if you don't need it, you just take a month off, not pay the fee for it, right? So they're a transaction based company. However, DocuSign is heavy into docs, and they beat last week, and I was completely surprised, which argues to me that Adobe has upside. I know they're not tied directly to DocuSign. I know they're in two different businesses. But I wonder if Adobe actually surprises this whole analyst community. I mean, generic outlooks mean they're not doing their homework, in my opinion, and they're just like taking. I mean, analysts have taken a real beating this year. Everybody came in very optimistic, and now they all have to turn negative just to catch themselves. I wonder if the transaction DocuSign argues that Adobe's going to do better versus these. They have a tough comparison to beat. But FX is an old story. Everybody already knows the dollar's stronger. I don't even know why they mention it anymore, but they do, these analysts. Breadth is not the best, so people aren't buying into the story. So I think if this company were to announce better earnings, that support you see down that chart there could translate into a $450 stock, or at least $425 or somewhere in that top of that recent candle. So I wouldn't be surprised by a beat here. DocuSign is sort of why I think that way. I would if DocuSign hadn't beat, I think I would have been a little bit more bearish. But these analysts are just what they are. They're herd like with the stock. There's nothing original to it. So it's fascinating to me.
Well, I'm just looking. DocuSign was up 17% last week, but it was coming off of a very big dip from about a month earlier. The stock was at 74 and it finished the week at 64 last week. Yeah,
the DocuSign. It's like the trading itself was it was the beat itself that I focused on. I was like, if they're going to beat on earnings, that means everybody's swinging the wrong way. Based on the negative sentiment around Adobe, I wonder if it's the same thing. Like everybody's just so darn bearish. The stock still is to still return revenue like 13%. And I don't know why it's so dour on the name. It's like, it is what it is. I mean, even going on to that dollar strength, that's another thing that Jay Pulaski's been pushing on, waiting for that to turn around, and we have seen the dollar weaken a little bit over the weekend as well. But let's move on to the next one. Manchester United reports on Friday.
We've covered the sports clubs earlier this year, and Manchester United holders have been having a bit of a roller coaster ride in their share price and club performance. Constant transfer rumours of Cristiano Ronaldo and an indifferent start to the Premier League season, you would think would cause some pressure on the share price. And it did. But these past few weeks, the stock has been ripping up. Brendan, what does the chart say to you?
So I hate these sports stocks. Like the Boston Celtics have one too. It's like stupid. But whatever. You want to own your stock, go buy one, put it on your wall, and you'll feel happy about it. Manchester United, obviously, a little bit more than that. It's been around a lot longer. It's direct play in the club. I'm not a Manchester United fan, so I loved it when they were suffering the first 2 games of the season. I just got a big fat. I always believed they're like the Yankees of the Premier League. They overspend and they never get it right. I mean, the Yankees haven't won in a long time, so I can say that, I suppose. But my Red Sox are very inconsistent as well. Anyhow, the run on this incidentally is on the back of the Chelsea sale. I think Chelsea went off for about $5 billion or so, some obscene number. Like the Russian oligarchs, like laughing all the way to the bank right now on that sale. Oh my God! I think he only paid less than $1 billion for it. The UK government's like, here, have take $4 billion and enjoy. You know, we don't like you. We won't let you in our borders, but you can have $4 billion. The Glazers won't sell. That's the Bucks owners. They refuse to sell. I think they think it's funny that the English media jumps on all of them all the time. So the stock, I mean, I think they got a value of like 4.3 billion. The company the Man U would probably sell for 5 billion. It's one of the biggest values in the world in terms of brand. I mean, Manchester United is synonymous with soccer. Like you think soccer, you think Premier League, you see Manchester United. It's just what it is. Stock's been running better since the soccer club's been proven better. Ronaldo's transfer rumors notwithstanding, and then they lost in the Europa League the other day too. So I like to see it when they lose. I'm a Tottenham fan. What can I say? Anywho, as for the stock, the breadth is actually improving. There is real buying in the name. I would wait for it to get over $14.5. That was a short-term top. You can see it right there. Maybe 15 is where it starts to run. I don't know what improve. If it can't get over $18-20 on a sale of $5 billion, I don't know what would get it over there. I mean, Manchester United had that nice run. You get a little excitement. But, you know, Manchester United's been dragging for years. So I think the stock will reflect that. And the Glazers aren't selling anytime soon. So all that hype about a sale will probably go away as well.
Now, before we start like it, love it, leave it, Brendan, we want to look back at the performance you have had with this. A lot of people think that you pick the names, but actually each week I choose the names and you do the work on them. Just the way I like it, someone else doing the work. You've also done some work on what the results have looked like so far this year. Can you talk us through these results, Brendan? Sure.
So I got the idea. We've been doing this segment since early April, if I'm not mistaken. Mehdi stepped in for 1 week, and then the two of us been at it since. We've been sort of covering stocks for a while, but this allowed us an opportunity just to flash out picks really quick. So we did some work on this over the last few weeks, and the picks are interesting. It's like, first of all, when we make these picks on week one, day one today, we take the opening price and then we set the closing price on Friday using Bloomberg's data. With the themes that you give, we find that it's amazing. The stock will follow if the stock will follow its chart. Let's just lack a better description. It will follow its chart based on the themes. Like we did at Weber, we did cooking in July, if I'm not mistaken. Well, that week actually was pretty remarkably decent. It had no theme other than we decided to talk about cooking. Earnings are key drivers with this. So earnings, obviously, the market is telling us many cases that heading into earnings, the chart is telling you what's going to happen. So today for Adobe's rallying. That'd be an example of, all right, maybe the market's telling us it's going higher. I don't know if I didn't do a like it, leave it for that one. But basically from the data, we created two different strategies. We did a 50%, buy 50% of your portfolio 1 week, 50% the next week. That strategy is shown 3L's 50 portfolio. It's that blue line. You can see over time it steadily outperforms the NAS and the S&P, the SPY. The second one is, you take the 5 picks that week, you buy them all or sell them all or whatever we picked, leave it, like it, leave it. And that has outperformed well. What's driven that of late, and I'd love to see what happens in this market in the fall, is we've had a lot of leave-its, which theoretically is a short because you don't want to own it, so let it go, right? We've had some decent calls there. Like NVIDIA was one of them. NVIDIA just kept falling, right? That was a tech name. I think that fell into whatever theme we had that week. I knew they had earnings. I don't know, but basically what we find is with the themes that you give, we have less volatility than without the themes. So I went back before our picks and just randomly picked stocks from January onward, found terribly more volatility. So I guess long story short, the charts are telling us, all right, the chart readings that we're using are working. The themes are working, keeping volatility down. It's the most interesting thing. And it's panned out pretty well. So the orange line is the 100%. You buy all 5 positions that week and you sell it on Friday. You can hedge out the following week with this. We have another model that we're using to hedge the S&P. It's a small little addition. No need to talk about it because it's too complicated in some case. But based on the level it, love it, like it, love it, leave it, tongue twister, the picks have done well. And we'll just continue to monitor this every week. We'll continue to do it every week. Like we'll have another open coming up in about 40 minutes. We'll put the 5 picks for the next segment out on our thing. And then we'll see how it goes. So far, so good. We find that when we're heavily loaded in like-its one week or heavily loaded in leave-its one week, it's best to be the other way in the S&P. I've often remarked, I don't want to be too bullish or too bearish. The month of August was very good to us. We had a lot of leave-its. So that's just the way it's worked quite well. And we're looking forward to continue it on forward. It's been, it's interesting how the sample is very effective in dropping volatility lower in terms of a theme or earnings versus just random selection. It's so far so good.
Well, listen, congratulations on that performance so far. It's the themes come up in many different sort of ways depending on how my mind is working on Sunday. Usually it's earnings related, but it can, like you said, like the cooking side of it was like the kicking off of college football. And it's like, all right, well, the chicken side of it. Like those are the sorts of themes that come through. But this week, where there's not really a lot on the earnings front, so we're looking more at the conferences that are going on. Obviously, there's a big one, the Detroit Auto Show. There's an Investor Day. There's also a Goldman Sachs conference as well. But we'll laugh about when I try to pronounce that in a second. But let's kick off like it, love it, leave it. We're going to start with Starbucks with their Investor Day on Tuesday.
One quick thing. On earnings, we find more firepower. On the earnings investor days, we find the status quo. Like they don't affect the earnings as much, strangely enough. Anyway, talk about that another day. All right, Starbucks. I would leave it. Ran into the 65-week and now is stuck in no man's land between 87.5 and 90. Also with the new CEO, it doesn't strike me as hip anymore to be in a Starbucks as a result. If they hired a younger guy who was exciting, I think that would make it hip, but it's not. So I would leave it.
Now, Detroit Auto Show is their first one in 3 years on the back of COVID. Let's start with Ford.
I like it. The power model, which is just breadth and trend. It's higher. It broke out of range a few weeks ago. I think we were talking about this 3 or 4 or 5 weeks ago. It's between 1350 or somewhere there. It looks like it's going to go higher, so we like it. Okay,
GM, General Motors.
Historically, I've hated General Motors. I just don't like them, period. But got to respect the chart. So we like it as it broke past 41. Wary of the breath. Needs more to get through the 65-week at 44. It gets through there. Go to 54, more or less.
Okay. STLA, Stellantis.
Stock's sitting right at resistance at 1350. Breath is mixed. It's below the 65 weeks, so it's really not exciting, so we leave it.
Okay, this is a stock I used to trade back in the day, MGA, Magna International. They're also expected to unveil its intelligent forced battery electric vehicle powertrain system for pickup trucks and light commercial vehicles. What are you looking at?
I love how these guys put up these fancy names, E-Intelligence. And stuff. Anyway, similar picture to STLA, right at resistance, breadth is mixed, below the 65-week. We'd leave it.
Okay, and then talking about funny made-up names, eBay is at the Goldman Sachs Communicopia Conference. I don't know where they come up with
that. Say that 3 times without messing it up.
it all weekend. What do you think of eBay?
Oh, sorry. I had to laugh a little bit, I guess. I would leave it. It's interesting. All I hear is eBay Motors lately on the radio. Strangely enough. The fact is I strangely listen to the radio. Anyhow. Power model's lower. So the breadth's not great. Broke through support at 46 a few weeks ago. It's trading like the small cap 600, strangely enough, even though it's a multi-billion-dollar company, hundreds of billions. Not entirely sure why it's trading like the small caps. Not something to think about, but I'd leave it.
Okay, well, listen, Brendan, that wraps up the show for us today. Thank you so much for your time. Great to get that breakdown on the triple Ls. You have a great week, Brendan.
You too. Have a great week.
And for everyone watching, don't forget to look at Open Exchange for all your virtual event needs. Brendan Bresney in the background, thank you for your help as always. And for everyone else, good luck investing.